Hello and welcome to Moneylife News and Views. I'm Debashis Basu. Once again, India has stumbled into a mini foreign exchange crisis, and the government is therefore contemplating reforms. We won't do any reforms. When the going is good, we only think of reforms only when things go bad. According to news reports, New Delhi is preparing measures to support the rupee and finance a widening current account deficit. These measures may include reducing long term capital gains on listed equities and government bonds and lowering withholding tax on interest income earned by foreign investors. To curb capital outflows, officials are also considering reducing the annual limit under the liberalized remittance scheme from the current $150,000 per individual. Why do we need to take such measures? Well, the rupee has gone on a sharp decline over the past year due to large current account deficit, persistent foreign portfolio outflows from stock market, poor foreign direct investment inflows, negative net exports, and capital outflows from India through both LRS, that is liberalized remittance scheme, and outward foreign direct investments. There's a lot more people putting money outside India than people putting money into India. It's quite a strange situation, but that's the fact. The result of this is alarming. For the first time, India is running deficits on both its current and capital account. Current account is related to imports and exports. Capital account is related to flows of capital, whether foreign direct investments, NRI deposits, portfolio investment by foreigners, and so on. Now, this twin deficits on both current account and capital account is the least commented marker of the seriousness of the current situation. So concerning has the situation become that the Prime Minister Modi recently appealed to citizens to curb non-essential imports such as gold purchases and overseas travel in order to conserve foreign exchange. Now, this may seem like a sudden crisis, but India has long run a current account deficit because it imports more than it exports. Why is that? Because imports of gold and oil and electronic products we cannot do without. Exports, we don't care much about our competitiveness in the export market, the quality, and so on and so forth. But this problem, more imports and less exports, was usually an irritating thing, but never a crisis, because the gap between our more imports and less exports was always been funded by foreign capital through inflows of different kinds, generating a surplus in the capital account. Now, what are the different kinds? I've already mentioned, which is NRI deposits or foreign portfolio investment into the stock market, foreign direct investments by foreign companies into India, and so on. But now, thanks to a series of policy mistakes, half-baked reforms done in some of these areas, and very poor execution, India faces deficits on both the fronts. So the combined pressure on the rupee and foreign exchange reserves is the main reason the currency has fallen from 84 last year to 94 this year. In 1 year, a 12% depreciation. Now, as I mentioned briefly before, this is neither sudden nor unforeseeable. Everybody knew about what I'm talking about, which is we don't export enough and we are living off imported capital to some extent. Now, what is a task of a serious state? As any serious government would know about this, identify, okay, these are our vulnerabilities. We are carrying on now, but if something goes wrong, if oil prices shoot up, if gold prices shoot up, something happens to our exports, we will be in trouble. All of these happens in the last 1 year. Gold prices shot up first, exports took a beating because of Trump, and oil prices went up. So all these things came together, and all of these things can come together is something any serious government should have known. What would a serious government do? They would identify these as weaknesses and address them long before they become emergencies. India has always known that spikes in oil and gold prices expose economy's weakness. So reducing export dependence should therefore have been number one priority. Equally, India has long needed to strengthen its export competitiveness and narrow its current account deficit, if not eliminate altogether. Yet, progress on both fronts have been very poor. India is still exporting their old stuff, which is diamond, gems, and jewelry, textiles, and all of that. We have no competitiveness in the export market, except if the rupee weakens, that export goes up. You know how what kind of competitiveness that is. In the meantime, while the current account was should have been repaired, policymakers should have welcomed foreign capital to ensure there's a surplus on the capital account and support the currency stability. Instead, the Indian government, believing its old slogans of Atmanirbhar Bharat, actually discouraged foreign capital. Now, we need foreign capital not just because of rupee and the weakness and all of that. We need foreign capital for another reason, very, very strong reason. Even if there was no rupee crisis, we would have still should have gone and looked for high quality foreign capital to be invested in India and made sure that all the impediments for them were removed. What is that reason? That reason is India simply does not have enough of domestic savings to match its ambition of 8% GDP growth and become a Viksit Bharat by 2047. What is the math behind this? Economic growth comes from four sources. Private consumption leads to economic growth. Government expenditure can lead to economic growth. Net exports, as I've been harping on, more exports than imports leads to economic growth. And the fourth, the most important factor, is investment leads to economic growth. Private consumption is already about 61% of GDP, and it can't be pushed up that much more. I leave out government expenditure because that's not a very productive thing. GDP can grow up, but who would want more government expenditure, right? Given the quality of governance. Net exports remains negative, as I harped on some time ago. And so all our growth ambitions at the margin, all of these will keep pushing India's growth up to 5%, 6%, 6.5%. But if you want to make a leap to 8% plus, that marginal additional growth will have to come from investment. Investment in productive fixed assets over a long period of time with a high quality of output, which then goes back into it in a very virtuous cycle. Now, given the current consumption of GDP, I have estimated that investment must contribute about 3.75 percentage points to the annual growth to achieve 8% growth. So the investment itself would have to need to expand by about 8.9%. This is according to my calculations. Historically, this is borne out. This is an obvious thing. It's borne out because whenever India has experienced periods of rapid growth, it has always come from investment. Investment has been the driving factor. Now, what is investment? Investment requires capital. India's domestic savings rate is very high, but our ambitions are much higher. If savings remain at roughly 32.5% of GDP as it is today, the country would need a lot of foreign capital, equivalent to about 2.1% of GDP annually, to bridge the gap, approximately $88 billion, let's say $90 billion or $100 billion a year. And how much are we getting in terms of foreign capital? We are running a negative capital account balance, zero, minus. Foreign capital comprises FDI, portfolio investment, external commercial borrowings, deposits, and other flows. Of these, borrowings and deposits create liabilities, right? While portfolio investment is only semi-permanent and can reverse quickly, as we've seen in the last 1.5 years, foreign investors are continuously taking money out. It is foreign direct investment by companies into projects, into products which they manufacture here. That should have been our one and only goal all these years. I don't care whether it's Congress or BJP or whoever, every single government, right from the beginning of our independence, should have courted high quality foreign direct investment, which would create manufacturing capabilities, which would transfer technology and skills, which would give employment, and so on and so forth. And yet, net FDI in FY26 amounted to just 7.7 billion. Although that represented a modest recovery from a dismal 1 billion in FY25, it was still dramatically below the 27-28 billion dollars seen in FY23 and 24, and in any case, even at 27-28 billion is nowhere near the 90 billion or 100 billion I estimate by commonsensical means that we need every year. Attracting foreign capital was, after all, one of the principal reasons India liberalized its economy in the first place. Now, this is nothing new. None of these things are new. Every major economic success story globally has been fueled by foreign capital attracted through deliberate policies and accorded strategic importance by the state. According to economic historians, among the many tasks of growth promotion, recruiting foreign investment stands out as top priority that must be entrusted only to the most competent people. We need a ministry staffed by technocrats, by a minister who understands economics and growth and development economics to do this, right? In East Asia, investment promotion is the job of elite agencies that are professionally qualified and equipped to woo investors as well as coordinate investment policies for the entire economy. In Singapore, this job is given to Economic Development Board. In South Korea, the equivalent trade body is KOTRA, which is Korea Trade Investment Promotion Agency. But the importance of attracting long-term FDI to achieve 8% growth seems to have faded away from the view in India. At the same time, buoyed by claims of India's emergence as an economic superpower, policymakers moved to discourage portfolio flows, first by introducing capital gains tax on listed equities in 2018 and then by raising the rate further in 2024. We even advertised and crowed about the fact that, well, we have domestic institutional investors. We don't care if foreign investors sell and go out. Far from talking about getting FDI into manufacturing and other businesses. Now, it is true that a lot of FDI is coming in. It's not that net FDI is rising. Now, you would be surprised to know that a lot of FDI and a lot of other kinds of capital flows are actually going out from India. I mean, I am really surprised to see when the rupee is so weak, why would India allow that? Now, a large part of these outflows do reflect repatriation and disinvestment by foreign companies, which amounted to $54 billion in FY26. But there's another component. Indian firms investing abroad through equity injections, loans, and guarantees, which reached 30 billion last year, in FY26. What is it of value to India if India puts money in other countries and creates jobs over there? Now, it's an obvious question. Why would a country that requires close to 90 billion in net foreign capital annually to create jobs, build productive capacity, and sustain rapid growth permit $30 billion of capital outflows and $250,000 per individual to be invested abroad? Do we want to create jobs there or do we want to create jobs here? And all that contributing to the pressure on rupee. I have no answer. I'll try and explore and probably do a video blog sometime soon on this. Thanks for watching. And if you did like it, do share and do subscribe.